Behavioral Inflection Point, Eclipsed. Welcome to the Foundation for the Study of Cycles with your host, Ron William, Development Director, ahead of our FSC Mid-Year Financial Cycles Summit. Our key points today: behavioral inflection point, triple whammy headwinds, market scenarios. Some of this information will be available post-session on our FSC website and monthly blog. Let's dive into this concept of a behavioral inflection point, potential eclipse, and the idea of market sentiment unwinding as we speak. The big question: is the great unwinding of a mirage trade already happening? According to my work, market sentiment overshot as part of a behavioral inflection point across risk proxies in the last 6 months from December 2023, already pricing in the so-called promise of a Fed dovish pivot. Is this now a likely mirage? As you can see there by the cartoon, credit to Hedgeye, rate cut, no, just another mirage, as they stand in the desert looking out into the distance. The recent tactical unwind signals a vulnerable market, which is now in reassessment mode to the changing market regime. I know risk assets, US equities as a case in point, NASDAQ, S&P 500 is elevated at new all-time highs. But as we'll see in a moment, there is a loss of momentum, price divergences, looking at other indices as well as momentum gauges, plus a range of other risk headwinds pointing to potential unwind in the coming weeks and months, which ultimately may lead to some volatility. So that's the base case of the analysis that we're going to look at in this session today. Keep in mind, looking back at the key points in this cartoon image, we're basically looking at this great unwinding of a mirage trade, which is leading to that reassessment mode, to a changing market regime where likely policy shift and broadening tail risks is more broadly expected. Look for a non-consensus second half of this year in stocks and bonds in particular. Now, follow-up question: crowd wisdom or contrarian signal? Following one of the most anticipated recessions that failed to materialize from 2023, investors once again have become excessively complacent at what seems to be precisely the wrong moment. Could this be crowd wisdom or a contrarian signal? The chart that you have here on the screen is showing mainstream consensus for a soft landing, i.e. Goldilocks scenario. I've termed this behavioral inflection points, which applies to crowd wisdom at late stage cycle, particularly as you can see here, point 1, 2, and 3 as a potential strikeout signal. I'll just quickly highlight these areas on the chart on the right side. Each one retrospectively an inflection point in time. 2023, the record recession alert; 2022, inflation rate shock; and 2021 is the post-COVID recovery boom that led us into this elevated environment where complacency is at record extremes. But keep in mind that each time predictions have been incorrect, we've either doubled down or flip-flopped the other way. Here and now, macro surprises are negative. Another way of thinking of this is bad news is bad, whereas before, good news was good or bad news was good in a rising trend, low volatility environment, which was the condition of certainly the year-end rally that we saw in 2023 extending into 2024. Looking at the chart here, we see in macro terms a bout of negative surprises that continue to weigh. This includes softer than expected US growth, hotter inflation, and negative market sentiment, ultimately net, which is being reflected in these multiple economic surprise indices all below zero. This is looking at three key proxies as developed by Citigroup, Bloomberg, and Goldman Sachs. Now, of course, the numbers to watch in recent times and in the near term will be the labor market and how that impacts general economic health. So do watch out for ongoing negative macro surprise as a net effect of this behavioral inflection point unwinding. Reviewing the global cross-asset model, which is based on a trend ranking, short-term, medium-term, and long-term on the left side of your screen, it illustrates a paradoxical greed and fear rotation. Basically, there's a change of season. And the elevation that we can see in risk proxies like the US equity market is what is strong on this chart. You can see the USA previously unwinding, but now back up to all-time highs. That's also supported with European and UK equities, UK especially elevated by resources. But at the same time, we have risk assets, I should say, risk-off assets and safe haven assets such as gold and US 10-year still elevated as well as part of that rotation. Gold, of course, overbought after hitting that target of 2,400 and US 10-year yield looking like it's going to unwind in the near term. But still, this bifurcated rotation between greed, fear, risk on, risk off. Now, if we look at the actual decline that did happen just 1 month from now, from a behavioral perspective, it's important to keep in mind this was the worst in 14 months since the banking failure of 2023. So there's this echo fear factor that remains in the market. In addition to that, investor sentiment continues to be in reassessment if we look at the VIX volatility indicator, which although did not spike that much in recent times, it still has further upside ahead if and when we break above the 21-23% threshold. Now, here are the key triple whammy headwinds to factor in the coming weeks ahead. 1, momentum exhaustion and divergence. 2, rotation fragility. 3, and most importantly, cycle asymmetric risk. Looking at momentum exhaustion and divergences, essentially this is part of the behavioral inflection pattern that is still active on the US equity market, S&P 500 as an example, marked by a potential bull trap signal above the rising trend channel drawn on the chart there on the left near 52.50. The risk level around where we are now, 55.30, is where we still need to watch for a potential extension higher. But look for a potential loss of momentum, failure to the upside that could lead to a reversal lower, and what could end up being a bull trap signal where essentially leveraged long trades are forced to exit, and then this could trigger a sharp correction. It's still not clear as to whether this will be a big sizable correction, but certainly a fast correction as we saw in recent times, which would likely extend to a minimum of 10% with overshoot risk. Look to the base of this rising 2-year channel as a most obvious target, which is just below the 200-day moving average, 10% or so as a base case. Supplementary to this, there is non-confirmation on a variety of indices in terms of the Dow non-confirmation signal, index industrial versus transportation, Russell 2000, as well as the equal weighted S&P 500, which I will just highlight on the chart on the top right, figure 2. Keep in mind that suggests a potential unsustainable rally that is continuing to be weak. Momentum exhaustion and divergences if we're looking at the actual cross-market non-confirmation. Second, rotation fragility. Concentration risk still weighs at historic Y2K extremes. It doesn't suggest that we're in bubble territory, but when we were last in a big bubble, that is how extreme concentration risk was. Here, the spotlight is on mega cap growth tech stocks, part of this grand innovation cycle, but at risky concentration levels. Now, just to emphasize the point, the single stock concentration risk is at record highs as we speak. And case in point to explain, 54%, not 5, not 10, not 30, but 54% of the S&P 500's year-to-date gain is just 4 stocks. I'll say that one more time. 54% of the S&P 500's year-to-date gain is just 4 stocks. Now, of course, the biggest stock of them all is and will continue to be NVIDIA, but as part of the FANG mix, the high beta impact is far stronger now than before. What that means is if any one of these single stock names, as amazing as they are with their strong technological innovation future ahead, if any one of them wobbles or corrects, there'll be a far stronger impact on the market. And we just recently saw NVIDIA down 25%, then up 40+%. But just keep in mind that volatility is back, and part of the new regime that we've shifted from last year into this year. And then the last point to make, which is a lesser known factor, but still relevant, an indicator called the Hindenburg omen, which has signaled just recently based on 3 key factors: market trend, high-low expansion, and negative breadth. What does it mean? It also suggests market fragility, which will lead to a correction or crash, which could be a flash crash or a much bigger move. Time will tell. But all of this together emphasizes the second factor of rotation fragility. Last but not least, cycle asymmetric risk. Now, here I just want to preface with a key point. Timing in life and markets is everything. We know that, especially here at the Foundation for the Study of Cycles. It's part of our key mission and research work. But keep in mind that it's always worth looking at a dynamic mix of cycle data that will offer higher conviction confluence. Often it can also create lead and lag signals, as well as sometimes divergences within time itself. So it is useful to look at more than one timing data or framework so that we can have a little bit more of a diversified view on timing itself as we marry it up with price and market analysis in general. So here we're looking at 3 key timing methods. One is the FSC timing model itself, our flagship digital signal indicator. 2, seasonality, which is super important for tactical risk reward timing on cross assets, equities as being a popular example. And 3, the US presidential election cycle, which I've done a separate FSC video monthly vlog on with more information for those of you that want to do a deeper dive. Now, if we look at the FSC timing model as our first timing method, This shows a signal right here and now, but there is a price and time divergence. Let me just quickly highlight price up, but time remains down in terms of the expected move ahead. Now, one of two things can happen. Either price can remain strong and win out. That would suggest a false timing signal this time around, or price and the market is on borrowed time, which would mean a sharper correction, flash crash type move in the coming weeks and perhaps months ahead. There could be other options as well, but these are the two high probability polarized outcomes. The other point to make is that this signal does suggest a sell in June phenomena, not May, and I'll support that with further seasonality analysis, which corroborates the same point. And the last point I'd like to highlight is the track record of this latest FSC timing model. It did correctly predict the last shakeout in April, just after the solar eclipse. There's an FSC vlog, monthly video that I did on that for those of you that would like to dive deeper into dynamic natural cycles. And then you can see here the bottom in November of 2023 and the high in July of 2023. So a viable track record looking at the last two sine wave signals of the FSC model. Here and now, if it were to play out, it would be sell in May and late June, and more importantly, during volatility in August and September, which is typical also for seasonality patterns. The second one is seasonality itself. Remember what I mentioned about summer volatility with a key amplification during June and September. That's what statistics shows when we do the back test on 100 years worth of equity market performance. The typical seasonality pattern that we know is sell in May, which follows a typical climactic April earnings season, which then falls into the month of May. But here's the key point I want to highlight. The month of May is a low positive performing month. I'll say that one more time. The month of May is a low positive performing month. So although it does fall in performance, it remains positive in terms of average performance. So the real sell in May effect, or the real negative seasonality effect, is actually June, not May. So I suggest that we all reframe this pattern to sell in June, not May, in terms of the real drawdown that typically happens. Now that follows into the midsummer rally, typically in July and August, which then sets us up for the bigger and most important drawdown, which is most reliable in September and October as part of that autumn fall correction crash signal. Now, last point to mention is that June, if we go back to the month that we're in terms of historical drawdowns worthy of note, there are three to highlight. One, the 2022 inflation shock, just highlighted here. Two, the 2008 global financial crisis. And three, the 1962 Kennedy slide. These are the big outlier drawdowns in the past for the month of June. We'll see if this happens either this year, 2024, or even next, 2025. But certainly it's worthy to keep in the back of our mind in terms of the extremes that market can behave during this month. Remember, just to end, September and October is when the autumn fall crash pattern takes effect, and that's the most reliable of this pattern. And then last but not least, seasonality, not for markets in general, but for the US election pattern. So what does that suggest? Now, the first point is that second-term presidents typically suffer from what is referred to as a lame duck effect. The whole point of the presidential election cycle pattern is that the incumbent leader naturally wants to get voted in again, so they use policy levers in order to boost confidence in the populace and increase votes as a consequence. that can either be through, market mechanism itself or through policy. But the idea of a second-term president is that they often have less firepower to do so, and so the market effect is diminished. That's the first point. Now, the second point is the year of the election in general, like whether it's the first election or not. That is a pattern that is based on uncertainty and certainty. So we can just see here on the chart on the left, showing pre-election uncertainty in the first half of the year, partly because the front-runner leaders are not clearly known. Only until the summer period, when the debates kick off, and then there's more indication not just about the front runners but also about their policies for voters to be more clear, confident, and decide what that means for their vote, but also for the market. Now, that leads to a summer rally, typically. That averages 7% versus the average of 3 to 4% in that typical time period during election periods. And then in the last 2 months before the election, that's when we get a further drawdown and volatility. You can see the second box there highlighting that typical and intuitive pattern. Now, after the US election, what is most viable is a switch from uncertainty to certainty, because we now know who the new leader is, whether it's a repeat of the past leader and policy or someone new. There's clarity at least about who's going to be in the White House, and market tends to perform better into a year-end rally. That's the pattern. But what I do want to highlight is it's a second-term president, and so we could have a lame duck effect with diminished market certainty and returns. Two, this year, unlike any year, the year of 2024 is a unique setup. And this is why it's really imperative that we do not apply a one-size-fits-all approach to this US presidential cycle pattern. 3 reasons I'm going to cite here. And then if you want to dive deeper, look up the FSC video vlog just published. The first point is certainty of front runners this year is the strongest ever. Early on in the year, both current President Trump and former ex-president, Biden and Trump, I should say, were recognized front runners early in the year. Typically, results are more clear in the second half of the year running up into the presidential election cycle. So that's one, certainty of front runners. 2, policy variation is wider now compared to past presidents. And 3, the uncertain macro environment, which continues to be a wild card, in particular, geopolitical risk. Now, I just want to wrap on macro scenarios and ask this grand finale question: what could be the pain trade ahead that we can prepare for in order to have various ideas as to what to do if and when we get a switch from expectations. Now, one historical analog that is worth looking at is the Tech 2000 melt up phase, which is similar in terms of the extremity of the run up to the upside, and certainly the rational exuberance that has been strong in the market. The theme of this chart is party like it's 1999 until the music stops. Big question as to when that might be. But what's interesting is, of course, the historical rhyme that we're seeing between Tech 2000, which is the blue line, versus here and now, the yellow line. Now, this chart, if and when updated, should actually show the all-time high melt up phase continuing. So the yellow line still pointing up, not down, since this chart was updated. Then we still have a 3-stage corrective phase ahead if and when it happens, which would be a fall, oversold rally, and rest to fall. Now, the key point about each of these stages is that the fall would typically be 10 to 20% minimum, not 5, 6, 7%, which is what we did see in the latest shakeout in April. The second point is that the oversold rally typically does not break to an all-time high. The market traditionally demonstrates vulnerability and clear signaling of a bear market to follow, and so that's the norm of what to expect. And then, of course, the rest of the move, that downtrend waterfall decline, is what follows. And according to this analog, that could appear into the US elections, which may or may not lead to a year-end rally. What it does suggest is, volatility at the very least happening in this new market regime that we're in. Now, as part of that wild card macro scenario, watch inflation and a potential resurgence. And in doing so, think 1970s. Now, according to my work, as part of further macro surprises ahead, most notably inflation, rates and inflation will remain elevated higher for longer as part of one of the most important cycles in economic macro cycle work, is the Kondratiev wave, which impacts interest rates, inflation, but also social mood and wars. And here you can see a three-wave inflation volatility from the 1970s. That's the blue line, compared to here and now in orange. And so the feel-good factor that we're all experiencing is that inflation has more than halved. You can just see there in the second wave, inflation down from that extreme high, which was in 2022 during the shock in interest rates and inflation, coinciding with the geopolitical tensions between Russia and Ukraine. Here and now, this expectation of a Fed pivot or a Fed cut naturally was part of this decrease in inflation, but could be premature and false if and when we get a resurgence ahead. Either way, expect rolling waves of volatility akin to 1970s, coupled with macro risks. Remember, the historical analog already implies a larger wave ahead projected into the second half of this year. So for the next 6 months to 12 or more, we could see something more in line with this chart. Now, a consequence of this would be a rise in commodities, and this is a super cycle commodity chart theme that I'm sharing with you here. It's a ratio of commodities versus equities, and when this chart is down, it means commodities is underperforming equities and vice versa. Now, of course, it's also marking the ongoing restrictive monetary conditions for financial assets and consequential secular inflation forces ahead, as well as the long-term structural K-wave that I just alluded to, amplified by the debt burden. Now, the last commodity outperformances that took place was in Tech 2000, which another reason why I'm alluding to that point in time. And then before that, the biggest extreme was the 1970 Nifty 50 stock bubble. But the point is, this year to date, commodities have outperformed to the tune of 50% if you're looking at industrial metals, copper, precious, silver, and energy stocks, with the underlying oil market still to follow, if and when. But despite the absolute outperformance in some commodity markets already, the ratio, the relative performance of commodities versus equities is still super cheap, oversold, and due a generational rotation. So keep that in mind as a potential repositioning in the portfolio as rotation and volatility changes from one asset class to another. Ultimately, a new adaptive strategy is required for this ongoing disruptive environment that we're likely to embark on. And then to end, one of my favorite subjects, behavioral finance and what it means for our trading success. The simple point here on an educational insight is that fear, or FOLO, fear of losing out, is greater than greed, FOMO, fear of missing out, during volatile markets. And that's demonstrated by the 3 lines on the chart that you can see there, highlighting that if investors, traders exclude the 10 worst trading days, you will by far outperform most strategies in the market. Why? Because risk management is paramount. Now, if we take the opposite side of the same coin and look at the performance of missing out the 10 best days, which is the gray line at the bottom, you still do well, you still make money, but it is the worst performing. And then in the middle, it's buy and hold, which does well over time, but you have to really look at some of the disruptive cycles to see how viable that is. Take note of the well-known market wisdom shared by many pioneers, highlighted on the right. Warren Buffett warns of the importance of risk management in his biblical reference to Noah's Ark principle: predicting rain doesn't count, building arks does. While Stanley Druckenmiller recalls his worst trading mistake during the Y2K period, despite 30 years of consecutive winning streak, due to FOMO extremes that he was experiencing and the need to play. So the key insight here is, fear and risk management being more important than greed and outperformance. Clearly, the sweet spot between the two is most important. The other factor to keep in mind is that we need to adjust from one to the other as the market environment changes, as it already is in this year of 2024. That's it from myself, Ron William. Behavioral inflection point eclipsed. We looked at the triple whammy headwinds, various market scenarios, more resources available on our FSC website and monthly vlog. Honor and a pleasure to share these insights with you. Please stay in touch via email or social, QR code on the screen. And just to end, thank you. Welcome any feedback or questions, and please register for our FSC mid-year event. Look forward to hosting and engaging with each of you with our many speakers that will follow. Thank you very much.